Preparing for a Boeing Finance Manager interview questions and answers interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Walk me through your background and explain why you want to become a finance manager at Boeing. My background combines financial planning, operational analysis, and team leadership in complex businesses. I have managed forecasts, investigated performance gaps, improved reporting, and translated financial results for non-finance leaders. Boeing interests me because its decisions involve long product life cycles, engineering trade-offs, supply chain risk, and significant customer commitments. I would bring disciplined analysis without losing sight of safety, quality, and execution. The finance manager role appeals to me because it connects daily operating choices with long-term program economics. While answering, connect your finance experience to operational decision-making, complex programs, leadership, forecasting, and Boeing's aerospace mission. Explain why safety, integrity, long-cycle development, and cross-functional partnership make the role particularly attractive. Question 2. How would you build an annual operating plan for a Boeing business unit? I would start with the operating model, deliveries, production rates, pricing, backlog, labor hours, material costs, overhead, capital spending, and cash timing. I would validate assumptions with program, engineering, supply chain, and sales leaders rather than simply extrapolating history. Next, I would create base, upside, and downside scenarios, identify key risks, and document ownership. After approval, I would establish monthly forecast reviews so the plan remains a management tool, not a static budget. Make sure to cover operational drivers, volume and pricing assumptions, labor and material costs, program milestones, capital needs, risks, scenario analysis, alignment with leadership, and monthly ownership of plan versus actual performance. Question 3. How do you analyze a significant unfavorable variance in a Boeing program? I first separate the variance into operational drivers instead of accepting a single unfavorable percentage. For example, I would distinguish lower deliveries from labor inefficiency, supplier pricing, material usage, overhead absorption, and an updated estimate. I would then compare actual data with the program baseline, interview responsible leaders, and test whether the issue is temporary or structural. Finally, I would quantify corrective actions, assign owners, update the forecast, and escalate material risks promptly. In your answer, talk about decomposing the variance into volume, price, mix, labor efficiency, material, overhead, schedule, and estimate changes. Emphasize root cause, evidence, corrective action, accountability, and transparent escalation. Question 4. What is program accounting, and why is it important in aerospace manufacturing? Program accounting manages the economics of long-lived contracts or product families whose costs and revenues develop over many periods. In aerospace, results depend on delivery schedules, production rates, learning curves, supplier performance, and estimated costs at completion. Finance must continually reassess those assumptions because a modest change can materially affect margins and earnings. Strong program accounting combines accounting compliance with operational insight, ensuring management understands both reported performance and the economics driving future results. Be sure to mention long production cycles, learning curves, estimated cost at completion, production rate assumptions, forward losses, revenue recognition, and the need for disciplined estimates supported by operational data. Question 5. How would you calculate and manage an estimate at completion for a major aircraft program? I would begin with the approved contract or program baseline, then reconcile incurred costs and physical progress to the latest production plan. Remaining costs would include labor hours, material commitments, supplier estimates, overhead, engineering, quality, and schedule-related risks. I would challenge assumptions against recent actual performance and independent operational evidence. I would also run sensitivities for rate, productivity, material inflation, and delivery timing. The final estimate should be documented, reviewable, and actively managed each month. Focus on contracted revenue, incurred costs, remaining labor and material, overhead, schedule, supplier commitments, risk reserves, learning curves, and sensitivity analysis. Explain how you would challenge assumptions and communicate confidence levels. Question 6. Describe how you would forecast cash flow for a Boeing program. I would build the forecast from operational events rather than applying a broad revenue to cash ratio. Key inputs would include customer advances, milestone billings, delivery timing, collections, supplier payment terms, inventory purchases, labor, tooling, capital expenditures, and claims. I would reconcile the forecast to the balance sheet and investigate changes in working capital. Scenario analysis would show the liquidity impact of delayed deliveries, lower production rates, supplier disruption, or customer payment delays, supporting timely management action. Make sure to cover customer billings, advances, deliveries, milestone payments, supplier terms, inventory, labor, capital expenditure, financing assumptions, and scenario analysis. Link forecast accuracy to liquidity and program decisions. Question 7. How do you evaluate working capital in an aerospace manufacturing environment? I view working capital as an operating system, not just a finance metric. I would analyze inventory by stage, age, usability, and production requirement, receivables by customer and collection risk, and payables by contractual terms and supplier health. I would also monitor contract assets, advances, and delivery timing. Improvements might include better demand signals, inventory disposition, milestone billing discipline, or supplier term alignment. I would avoid actions that create short-term cash benefits but jeopardize production resilience. Discuss inventory turns, receivables, payables, contract assets and liabilities, production rates, supplier terms, aged materials, excess inventory, and cash conversion. Balance cash improvement with continuity of production and supplier health. Question 8. How would you assess a make versus buy decision for an aircraft component? I would separate avoidable costs from allocated costs and compare the supplier quotation with the true incremental internal cost. The analysis would include labor, material, tooling, quality, logistics, warranty, capital requirements, and any capacity opportunity cost. For Boeing, I would also consider certification, technical capability, schedule reliability, intellectual property, supplier concentration, and strategic resilience. I would present a range of outcomes under different production rates and risk assumptions, rather than recommending the lowest apparent unit cost automatically. In your answer, include relevant incremental costs, avoidable fixed costs, capacity constraints, quality, certification, schedule, supplier risk, intellectual property, working capital, and long-term strategic consequences. Question 9. Tell me about a time you improved a forecasting or reporting process. In one role, our forecast relied on disconnected spreadsheets and took nearly 2 weeks to consolidate. I mapped the critical drivers, standardized definitions, and created a controlled reporting model linked to source data. I partnered with operations to validate assumptions and introduced a monthly review focused on explanations, not just numbers. The process reduced preparation time by roughly 40%, improved version control, and gave leaders earlier visibility into labor and material risks. Use a concise STAR structure. Quantify the original problem, explain the process or automation change, describe stakeholder adoption, and state measurable improvements in timeliness, accuracy, transparency, or decision quality. Question 10. How do you lead and develop finance professionals? I set clear expectations for accuracy, timeliness, judgment, and business partnership, then tailor development to each person's goals. I use regular one-on-ones, review work together, and give feedback close to the event. I also rotate team members through operational meetings so they understand the business behind the numbers. Delegation is purposeful. People own meaningful analyses while I remain available for coaching. Strong teams should produce reliable reporting and confidently challenge assumptions when risks emerge. Cover clear expectations, coaching, technical development, business exposure, feedback, delegation, succession planning, inclusion, and differentiated performance management. Explain how you build a team that challenges assumptions constructively. Question 11. How would you communicate a difficult financial forecast to engineering or program leadership? I would begin with the business implication, then explain the few operational drivers that matter most. For example, I might say that a supplier delay could reduce deliveries, increase inventory, and create a defined cash impact. I would distinguish confirmed facts from assumptions and show a range where uncertainty is material. I would also present practical options, owners, and timing. My goal is not to deliver bad news dramatically, it is to help leaders act early and intelligently. Emphasize audience-focused communication, fact-based messaging, operational drivers, quantified impact, alternatives, uncertainty ranges, and respectful challenge. Avoid presenting finance as merely negative or disconnected from program realities. Question 12. What controls would you prioritize in a Boeing finance organization? I would prioritize controls over areas with high judgment, materiality, or operational risk. These include estimate at completion reviews, revenue and contract assessments, purchase approvals, inventory reserves, journal entries, reconciliations, access management, and segregation of duties. I would ensure evidence is clear, ownership is assigned, and exceptions are tracked through resolution. Effective controls should be embedded in the process rather than added afterward. At Boeing, integrity and willingness to escalate concerns are as important as technical compliance. Discuss segregation of duties, journal entry governance, program estimate reviews, contract approvals, access controls, reconciliations, data lineage, compliance, audit evidence, and a culture encouraging escalation of concerns. Question 13. How do you ensure compliance with U.S. generally accepted accounting principles in a complex program environment? I start by understanding the transaction, contractual terms, operational facts, and applicable accounting guidance. For complex judgments, I partner early with controllership and technical accounting rather than waiting for period end. I document assumptions, alternatives considered, calculations, approvals, and supporting evidence. I also monitor changes in contracts, estimates, and business conditions that could alter the accounting conclusion. This approach preserves compliance while keeping finance connected to the underlying economics and ensuring issues are escalated before reporting deadlines. Mention understanding the applicable guidance, documenting judgments, partnering with controllership and technical accounting, reviewing contracts, maintaining evidence, monitoring changes, and escalating unusual or material transactions early. Question 14. How would you evaluate the financial impact of a production rate change? I would model the rate change across deliveries, revenue timing, labor hours, learning curves, material purchases, supplier commitments, overhead absorption, inventory, capital needs, and cash. A higher rate may improve fixed cost absorption but strain suppliers or quality. A lower rate may protect execution while increasing unit cost and extending the program. I would quantify near-term earnings and cash effects separately from long-term economics, then identify operational actions needed to make the revised rate achievable. Cover revenue and delivery timing, labor efficiency, fixed cost absorption, inventory, supplier commitments, cash, staffing, capacity, margin, and program accounting effects. Include both immediate and longer-term consequences. Question 15. Tell me about a time you found an error in financial reporting. What did you do? I once identified a recurring cost allocation that had been mapped to the wrong business unit. I first reproduced the issue, quantified the current and prior period impact, and checked whether reporting or decisions had been affected. I informed my manager and controllership promptly, corrected the entries through the approved process, and documented the analysis. We then updated the mapping table, added a reconciliation control, and trained the preparer. The lesson was to address both the error and its process cause. Explain how you detected the issue, validated materiality, contained the risk, informed stakeholders, corrected the records, identified the root cause, and strengthened controls without blaming individuals. Question 16. How would you manage supplier financial risk within a Boeing program? I would combine financial indicators with operational evidence. Warning signs might include deteriorating liquidity, late deliveries, quality escapes, labor shortages, unusual pricing requests, or dependence on a single supplier. I would quantify exposure through inventory, open purchase orders, tooling, schedule impact, and replacement cost. Working with procurement, engineering, quality, and program leadership, I would develop mitigations such as alternate sources, staged commitments, inventory buffers, or supplier support, with clear escalation thresholds. Focus on liquidity indicators, delivery and quality trends, concentration, payment terms, open commitments, contingency plans, cross-functional monitoring, and early escalation. Explain how finance supports continuity without making unsupported judgments. Question 17. How do you distinguish a temporary variance from a structural cost problem? I would examine the variance across time, products, sites, and operational drivers, then compare it with the underlying plan assumptions. A temporary issue might reflect a one-time expedite, timing difference, or isolated disruption. A structural problem would usually show repeated productivity gaps, persistent supplier inflation, unfavorable mix, or a changed process capability. I would test the explanation against leading indicators and corrective actions. If uncertainty remains, I would reflect a prudent range in the forecast and monitor it explicitly. Discuss trend analysis, operational root causes, repeatability, benchmark comparisons, leading indicators, management actions, and scenario testing. Explain why 1 month of unfavorable performance is insufficient for a conclusion. Question 18. What KPIs would you use to manage finance performance for a Boeing program? I would use a balanced set of financial and operational indicators: deliveries, production rate, unit cost, labor hours per unit, material variance, supplier performance, quality escapes, estimate at completion, margin, inventory, receivables, and cash conversion. I would avoid a dashboard overloaded with disconnected metrics. Each KPI should have a defined owner, threshold, trend, and action plan. In aerospace, safety and quality indicators belong alongside financial metrics because poor execution eventually becomes a cost, schedule, and customer problem. Include delivery performance, production rate, unit cost, labor efficiency, material variance, estimate at completion, margin, inventory, cash, quality, supplier performance, and safety-related indicators. Explain how KPIs connect to actions. Question 19. How would you approach capital expenditure approval for manufacturing equipment? I would first establish the operational need, capacity, safety, quality, obsolescence, or productivity. Then I would compare alternatives using incremental cash flows, utilization, maintenance, labor savings, depreciation, implementation timing, and residual value. I would stress test demand, production rates, and execution risk rather than relying on a single payback estimate. Approval should reflect both financial return and strategic necessity. After implementation, I would compare actual benefits with the original case and capture lessons for future investments. Cover strategic need, capacity, safety, quality, NPV, payback, utilization, maintenance, depreciation, cash timing, alternatives, execution risk, and post-investment review. Show that financial returns are not the sole consideration. Question 20. Describe a situation where you disagreed with an operations leader. How did you resolve it? An operations leader wanted to assume an aggressive productivity improvement in the forecast, while my analysis showed limited historical support. I first asked about the planned process changes and recognized the potential upside. We then separated committed actions from aspirational benefits, modeled both cases, and agreed on milestones that would unlock the upside assumption. The final forecast used the supportable case with a tracked opportunity. That approach preserved trust while protecting forecast credibility. Use STAR, emphasizing respect, shared objectives, evidence, listening, transparent assumptions, alternatives, and the final decision. Demonstrate constructive challenge rather than avoidance or escalation as the first response. Question 21. How do you use data and automation to improve finance decision-making? I use automation first to remove repetitive consolidation and validation work, then redirect time toward analysis. I would establish trusted source data, standard definitions, automated reconciliations, and exception reporting before building dashboards. For a Boeing program, that might connect labor, material, schedule, supplier, and delivery data to highlight emerging estimate risks. I would involve end users, test outputs against known results, and preserve review controls. Technology improves decisions only when the data and ownership are disciplined. Mention reliable source systems, standardized definitions, automated reconciliations, exception reporting, visualization, data governance, user adoption, and human judgment. Explain that automation should reduce manual effort while strengthening control and insight. Question 22. What would you do if a senior leader asked you to omit an unfavorable issue from a forecast? I would clarify whether the request reflected a legitimate timing judgment or an attempt to suppress known information. If the issue were supported by facts, I would explain the reporting and decision risk of omission and recommend showing the downside transparently, perhaps with a range and mitigation plan. I would document the discussion and involve controllership or the appropriate escalation channel if necessary. Accurate information and Boeing's ethical standards must take priority over protecting a short-term narrative. Be sure to mention integrity, accurate reporting, respectful clarification, evidence, escalation channels, documentation, materiality, and protection against retaliation. Emphasize offering transparent alternatives rather than simply refusing. Question 23. How would you prepare for a monthly program review with Boeing leadership? I would begin by reconciling actual results to the general ledger, operational systems, and prior forecast. Then I would isolate material variances, refresh the estimate at completion, validate assumptions with program and functional leaders, and identify risks requiring decisions. My review would emphasize trends, business drivers, cash, schedule, quality, and corrective actions rather than merely repeating financial statements. I would pre-brief stakeholders on contentious items and present leadership with clear choices, owners, and deadlines. Discuss validating data, reconciling actuals, identifying material variances, refreshing estimates, preparing concise messages, aligning with operations, anticipating questions, and presenting decisions, risks, owners, and deadlines. Question 24. How would you manage competing deadlines during quarter-end and forecast cycles? I prioritize work according to reporting risk, materiality, deadline, and decision impact. At the start of the cycle, I build an integrated calendar, confirm dependencies, and assign clear owners. I standardize recurring analyses and reserve time for review, exceptions, and unexpected issues. I communicate early when a dependency threatens timing, offering a practical recovery plan. Delegation allows the team to develop while I focus on judgment-heavy matters. Speed matters, but not at the expense of control or accuracy. Explain prioritization by risk and materiality, integrated calendars, delegation, early issue identification, standard templates, stakeholder communication, and quality checks. Demonstrate calm execution without compromising controls or accuracy. Question 25. What would success look like for you in your first 90 days as a Boeing Finance Manager? In the first 30 days, I would listen, learn the programs, understand the operating rhythm, and build relationships across finance, engineering, supply chain, quality, and operations. By 60 days, I would validate key forecasts, controls, reporting definitions, and major risks while identifying practical process improvements. By 90 days, I would have agreed priorities, measurable actions, and a clear team development plan. Success would mean earning trust, improving visibility, and helping leaders make better decisions without compromising integrity. Cover listening and relationship building, understanding programs and controls, learning systems, validating key assumptions, identifying quick wins, supporting the team, and establishing measurable priorities aligned with safety, quality, delivery, and financial performance. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.